All right, so let's kind of graphically take a look at this market for loanable funds. So let's have the quantity of investment and savings on this axis. We're going to have the interest rate on this one. We're going to label it lowercase I. So remember, investment is capital I and savings is S. Well, actually, savings is going to be NS for national savings. Okay, and so as we were just saying, we have this upward sloping national savings line, right? Where national savings equals Y minus C minus G. And it's not just any Y, it's Y star. And it's fixed at Y star, since this is a long run analysis. And as we said, we have this downward sloping investment, desired investment. And so where these two meet is going to be where I star equals the national savings. It's where the market will clear. And that's determined by this price. And this price is the interest rate. So at long run equilibrium, national savings needs to equal investment. And now this interest rate is endogenous, where national savings equals this, desired national savings equals this desired investment. That's going to be determining our interest rate, I star. So the interest rate is endogenous now, not exogenous. Now, just like any equilibrium, if our price is above or below this equilibrium price, this equilibrium interest rate, then we're going to have an excess supply or excess demand, in this case for the market for loanable funds. This is the market for loanable funds. So for instance, if the interest rate was up here, but I0, then at this high interest rate, the national savings, people are willing to save lots of money because that's the benefit of savings, you get this interest rate. But the cost of saving for these firms is too high to borrow that money or to invest kind of their own profits back in, because they could earn so much interest. And so here we're going to have excess savings. Which is going to cause this interest rate to fall until we're back at equilibrium. Now, if we are below equilibrium, the interest rate was below this I star, then households aren't willing to save that much money compared to how much of these loanable funds are demanded by these firms. So there is excess demand. So this excess demand for loanable funds. And so what's going to happen? Well, the interest rate is going to start to go up. That's going to cause the demand in terms of desired investment to go down. And we're going to end up right back at this Y star. So again, this I star. This I star is this equilibrium interest rate that's now determined in our long run by national savings and desired investment. All right, so let's talk about changes in this market for loanable funds. So let's just draw our market again. So this is the market for loanable funds. We have the quantity of investment and national savings on the x-axis. We have the interest rate, lowercase I, on the y-axis. We have this upward sloping national savings function, which is y minus c minus g. And sorry, y star, to be more particular, because we're at this long run equilibrium. And here's our desired investment. And where they cross determined our savings, our national savings equals investment. And that was determined by this interest rate, I star, this endogenous interest rate. Now imagine a rightward shift of the national savings function. So you can think of that happening through, a decrease in C or G, or kind of indirectly through a decrease in taxes as well. So national savings is going to go up if C or G go down. And so that's going to cause this rightward shift of our national savings. Oops, NS prime. It's a little bit ugly. NS prime. So for whatever reason, this NS shifts out to the right. Now what's going to happen is we have a higher level, maybe I'll put primes on both of these. We have a higher level of national savings and investment in equilibrium, and our interest rate has fallen. I decreases and investment increases. Well, this is going to lead, it's really just about the investment, is an increase in potential output. Right? So basically what's happening is investments going up. So our capital stock is increasing over time, which is going to cause economic growth and Y star. Well, Y star to increase over time, which is economic growth. So that's one way of increasing our potential output, is through these increases in investment through the shift out of savings. This is why savings is important. The other way we can think about it is if the demand for investment increases. And so let's quickly erase this and talk about that, because that's also going to cause an increase in our equilibrium level of, our equilibrium national savings equal investment condition down here. However, in this case, the interest rate's going to go up. But let's quickly erase this and draw out that diagram. So we can also see an increase in the demand for investment. So again, let's put our little I up here. This is the quantity of investment and national savings. On this axis, we have this upward sloping national savings curve, Y star minus C minus G. Downward sloping desired investment, where they meet determines our equilibrium level of investment and savings, national savings, I should say, where that equilibrium is determined by the interest rate. And let's say, imagine an increase in I, so desired level investment. This could be due to like a tax break or whatever. And so all of a sudden, this investment curve is going to shift to the right, which is going to shift our equilibrium to the right. So now we have a higher level of investment in national savings in terms of our equilibrium, the quantity side. Now the interest rate is going to increase in this case. So I is going to go up. I star equals national savings is going to go up. And we're going to get more investment and more national savings, which means more capital stock. So that capital stock is growing, which is going to cause our Y star to increase over time. Just like when we had the national savings. So just like when national savings went up, if desired investment goes up, again, we're going to get the same result in a faster capital accumulation, which is going to increase our potential output, which is long run growth.